Most people think that option trading is complicated. They assume you need years of experience, a finance degree, or a huge amount of capital just to get started. So they never even try. But what if I told you that some beginners are quietly using a simple, constructive approach to aim for something like 150 a week, not by gambling and not by guessing, but by relying on probability and consistency. In this video, I am going to break down exactly how that works step by step. So, by the end, you will have a clear and realistic understanding of how beginners can actually approach option trading. Before anything else, let me be very clear. This is not a get rich quick method. It is definitely not about turning 500 into 50k overnight. Personally, I've been using this simple strategy like this over time, and it has helped me to build up to six figures profit through investing. But that doesn't happen overnight, and it doesn't come without discipline. I'm sharing this so you can take something useful from it, not to set unrealistic expectation. And just as important, this is not risk free. Option trading carries real risk, and you need to respect that before you even start. But what we are talking about here is something different. We are focusing on a controlled, small, repeatable trades. The goal isn't to hit one big win, it's to stay consistent over time, manage your risk properly, and let the process work in your favor. Now, let's simplify everything. There are many ways to trade options, but one of the most common methods beginners start with is selling options. Instead of trying to predict a big price movement, you are essentially getting paid to take on probability. Think of it like this. You are saying that I'm okay owning this stock at a certain price, or I believe that this stock will stay above a specific level. And in return, you are taking on that position, you receive money upfront. That payment is what we call the premium. Let's break it down with a simple example. Imagine you pick a strong company, not random hype stocks, but something stable you actually understand and are comfortable holding it in the long term. You look at the current price and think that if this stock dropped to this level, I would actually be happy to buy it. So you sell a put option at that price level. Now, here is what happened. Someone from the other side pays you the money upfront for taking the obligation. That payment is called your premium. And from then, there are only two possible outcomes. If the stock stays above your chosen price, the option expire worthless and simply keep the premium as profit. If the stock drops below your strike price, then you may be assigned and required to buy the stocks at that agreed price. That's it. No complicated prediction, no guessing every market move, just a structural approach based on probability, risk, and discipline. Let's take a look at Nvidia. Right now, the price is around 198. And if you look at the chart, you can clearly see key support level forming around 193 with a deeper level near 178 if the stock continue to pull back. Before you even think about placing a trade, you need to understand what this key level actually means in context of your strategy. A lot of beginners make the mistake of jumping straight into the trade without first studying the structure of the chart. But the most important question you should always ask yourself is whether you are willing to own this stock at a lower price. If the answer is no, then you probably shouldn't be trading it in the first place. From there, the next step is to look beyond just the price action and start thinking about the intrinsic value of the stock itself, meaning whether the stock is fundamentally strong or worth holding long term, not just whether it is moving up or down in the short term. When you combine both technical levels and intrinsic value, your decision making becomes much more structural. You stop reacting emotionally to price movement and instead you start approaching trades with a clearer and more disciplined framework. If you are not sure about the intrinsic value of a company, you can always do some simple research online to get a better understanding of what stock might actually be worth. For example, we will look into Nvidia. You can search on platforms like Alpha Spread where the intrinsic value is estimated around 177, and they may even suggest a margin of safety price closer to 142 if you want to buy a deeper discount. On the other hand, if you check IBKR using Morningstar data, some experts may estimate that the intrinsic value is closer to 260. This shows an important point. Different sources will often give different valuation for the same stock because everyone has their own assumptions and model. Personally, I don't rely on just one opinion. I research multiple sources on intrinsic value, then form my own view based on that information. I even use tools like Stock Oracle to compare valuation across different companies. And for Nvidia, it might show that an intrinsic value around 208 depending on their model. At the end of the day, the key takeaway is that you need to decide for yourself what price you believe is the fair value for the stock you want to buy. Not because your entry price should always based on your own understanding, not just from a single number from the market. Now, let's talk about the main idea. How does this actually become something like 150 a week? If you break it down, 150 per week comes up to $600 a month. Converting that into USD at roughly 1.28, that's around 468 USD monthly. So the question is, how do we realistically aim for that using options? Let's go back to Nvidia as an example. The stock is currently trading around 197. If you look at an options expire around 30 to 32 days out, let's say around early June, you can start to see some opportunity. A common approach is to look at the strike price with a delta between zero point 0.2 and zero point 0.3, which is considered more conservative. In this case, you may see strike price around 185 or 180. For a bit more of margin of safety, let's focus on the 180 strike price. If you sell one put contract at 180 strike price, you could collect around 350 USD in premium. What does this mean is from the current price of around 197, the stock will need to drop roughly 17 to $18 or about 9% before you are assigned. While that kind of move is less likely in a short period, it's still possible, which is why risk management is important. With a delta around zero point 0.2, it suggests about 20% chance of the option ending up in the money, or roughly an 80% probability of success. But again, this is an example. Now, if you take that 350 USD and convert it to SGD, there's about 448 spread across roughly 4 weeks. That comes up to around 110 to 115 per week. And that is just one position. So you can start to see how By stacking a few of these controlled trades over time, the idea of aiming for 150 per week becomes more realistic. Of course, this is just an example. Stock prices move every day and nothing is guaranteed, but it gives you a structural way to think about building consistent income. Now, here is where most beginners mess up. They focus only on profit but ignore the risk. And in option trading, risk control is everything. That is why many traders follow a few simple rules. Number one, never risk too much on a single trade. Only trade stocks you actually understand, avoiding chasing high premium that look too good to be true. Because higher premium usually means higher risk. The goal here is to survive first and profit comes second. So let's apply this to our NVIDIA example and understand the real risk of selling a put option. If you sell a put at the 180 strike price, one possible outcome is that by expiration, let's say early June 2026, the stock dropped to 179 or below. In this case, your option get assigned, which means you are obligated to buy 100 shares of Nvidia at 180. That also means you need to be prepared with the capital, which is 180 multiplied by 100 shares or 18,000 USD to take delivery of the stock. This is why you should only sell put on stocks you are actually comfortable owning. On the other hand, if by expiration Nvidia stay above 180, let's say it closes at 185, then the option expire worthless. In that scenario, you keep the full premium around 350 USD as profit. These are two main outcomes when selling put option. Either you keep the premium or you buy the stock at your chosen price. It's a simple strategy, but understanding both sides clearly is what helps you manage risk properly. So, for this particular trade, you can think of it like earning 350 on a capital committed of 18,000, which give you a roughly return of about 2% for the month on this position. When you compare that to keeping your money in a bank that pays around 2% per year, the difference becomes very clear. Because on a monthly basis, there is only around 0.16% per month. And this is exactly what risk management is about. You are not just chasing the return blindly, you are evaluating whether the returns you are getting is worth the capital you are putting at risk. In this case, you are taking on the obligation to potentially buy a quality stock at a lower price, and in return, you are earning a significant higher yield compared to traditional saving. At the end of the day, investing is about one simple idea: beating inflation and outperforming low risk alternatives like bank interest rate over time. By structuring trades like this carefully, with defined risks and reasonable returns, you are aiming to grow your capital steadily rather than letting it sit idle. Option trading is not about being right every single time. It's about putting the odds in your favor and letting probability play out over many trades. You don't need a 100% win rate to be profitable. In fact, most consistent trader doesn't have one. What matters more is staying disciplined and consistently over time. Think of it like this: you are not making a single bet and hoping it works out. You are repeating the same structural approach again and again. It's like flipping a coin 100 times instead of just once. So, over time, the structure of your strategy, how you manage risk, how you choose trades, and how consistent you are matters far more than trying to predict where the market will do next. So if you are new, don't start with complexity. Start with the basic, understand how option works, what selling put actually means, how premium is collected, and most importantly, how risk is defined before you even enter a trade. Do not rush this process. Most people lose money not because the strategy doesn't work, but because they skip this foundation and jump in too quickly. If you are interested in this kind of content, where I break down how slowly and consistently building my wealth, consider subscribing to the channel for more video like this. If you are looking for a brokerage, you can check out my link in the description below. And if you want to use the same Excel sheet that I use to track my trades, I've included a download link as well. Hope you learned something from this video, and I'll see you in the next one.